As always, it's the global cues that are important, and it's over to Nigel for the world view.
It appears Santa came late, but at least he did arrive, because yesterday the US markets had a good run. You had the Dow scoring 1,000 points for the first time ever. And in terms of percentage points, the near 5% rally, that was the best we've seen in the past decade also. All those indices, they did very, very well in yesterday's trading session. Importantly, we had news coming in. The economic advisor said that the Fed chief's job is 100% safe. In the past, we look at the Fed to know what they have to say in terms of the job creation. Now, in fact, the markets are satisfied enough to know that Jerome Powell's job is safe. And that's why, in fact, that added a further stimulus to the rally yesterday. But there was buying across the board. The biggest gainers on the Dow are up for you on the screen. You had the Visa as well that was gaining in yesterday's trading session. And some of those stocks that have seen a sharp correction from the top, they as well did see buying. The likes of Apple as well were up and about in yesterday's trading session. But what was the positive news really was that retailers, they saw their best holiday sales in the last 6 years. That, in fact, was something that really fueled those retail stocks. All of them saw big gains in yesterday's trading session. And added to that, you did have that Amazon as well was up 9.5% odd, because the company has posted record holiday sales. That stock ended virtually at the high point of the day. We're keeping an eye out on Brent crude prices. And overnight, there was a rally of around 7 to around 8%. So some of those Dow components as well did do well on the back of that. Exxon as well as Chevron, both of them spiking up in trade. The dollar index as well should be on your radar, because that's moved marginally higher. Yesterday, it was at around 97.1. That meant that the yen did see some weakness, which is good news for that market. That's why that's the big outperformer. But otherwise, we have green on the screen, and the SGX Nifty as well is indicating a positive start to the tune of around 35 points out. Back to you all.
Okay, thanks a lot, Nigel, for that. Let's pose all of these questions to Jeff Dennis, who's the independent emerging market commentator who joins on the phone line. Jeff, hi. Good morning. As they say, hello. You don't know what to cook between Christmas and New Year. This is a little bit of a, uncomfortable time. But what's the sense you're getting as we head into the new year? How do you approach equities? I mean, after all the revelry is over, do you get a sense that reality might hit us, especially in emerging markets, which have had a very tough year?
Well, I think we have seen the markets become very oversold just before the Christmas holiday. I think the extent of the overselling, so to speak, was indicated by the tremendous rally we had today. As you said, a record points rally in the Dow. Two things were behind that. I think the market really did want to hear the news from Kevin Hassett, the White House chief economist, that Jerome Powell's job was safe. And also, as your correspondent said, obviously we had the good retail sales number. So I think the market was highly sensitive, I think, to much better news. And net, I think, although I'm sure it's going to remain very choppy, especially in the short term, with obviously liquidity levels being relatively low in this sort of holiday environment, I suspect we're going to see the rally gradually build here, because I think way too much negative news was priced into the U.S. market. And although emerging markets have had a tough year, of course, they've held up really very well during the most recent sell-off in U.S. equities. So as long as the U.S. market does stabilize here, which I think it will, I think emerging markets will look relatively good for next year also.
Okay. Good evening, Jeff, and thank you very much for taking our call. Should we trust Monday's fall, or should we trust Wednesday's rally? It's way too confusing. There are people on Monday and Tuesday who spoke about real fears of a liquidity crunch when the Fed rolls back its balance sheet. You don't worry about that?
Yes, I mean, I suspect what you should probably do is ignore both Monday and Wednesday, frankly. And obviously the charts tell you you've seen a very, very big sell-off since really the middle of November. And I think it did get overdone. I think the mood of the market was incredibly negative, and perhaps still underlying there are concerns. First of all, of course, you've got the government shutdown. You've got the the regular commentary from the president on tweets about the Federal Reserve Chairman. That's calmed down, I think, because of Hassett's comments today, which were pretty good. I think are very helpful. And you've got some better economic numbers. So I think the volatility's been, should we say, exacerbated by the holiday environment. But if you simply look at what's happened to the S&P, for example, it's run from 2,800 to below 2,400 in about 4 or 5 weeks. That looks oversold. The only way it's not oversold, in my view, is if we're going to have a U.S. recession next year. I think you'll get much slower growth, but I doubt you'll get a recession. So we probably need to chop off, the big losses and the big gains on a daily basis. But this looks like an oversold level to me as far as I'm concerned.
Okay, so it's an oversold level. There's another thing that people are talking about, the huge gap between the way the Indian markets and the US markets have moved. Is that a precursor to a crash? Because since mid-November, you've seen, the S&P 500 fall 10%, while the Nifty is up about 4%. Similar is the case with the VIX, right? The US VIX is up 40% since November, while the India VIX has fallen. Is that a precursor to some sort of a crash?
I would doubt it. I think the way it'll be a precursor to a weaker period is if eventually the U.S. market does go down again. I mean, I did say earlier, of course, that I think emerging markets have clearly held up. They did terribly at the beginning of October, the beginning of the fourth quarter in October and early November, but they've held up very well recently, and I think that's got a lot to do with the fact the dollar's been relatively stable. It's clearly been something that's been focusing on the U.S. economy and the concern about politics, etc., and the Fed chairman, as we've discussed. Also, of course, over that period, as your listeners know very well, we've seen a tremendous drop in oil prices, which has, of course, been something that has allowed the Indian market to hold up. So I would not expect the Indian market to crash from here unless the U.S. equity markets continue to go lower. And I think the only way the U.S. equity market continues to go lower from here is if you do see an outright risk of recession in the U.S., which, as I say, I think is relatively unlikely. Now, India's outperformed. It may well, lag a little bit if you do get a rally from here. But I don't think this means India's going to follow the U.S. from here. For that, as I say, you've got to have a much weaker global economy, U.S. economy, than I think is likely next year.
Okay. Just final question on India per se. We, of course, have the advantage of lower crude prices. Even after yesterday's 8% rally, a 54 is most welcome from an Indian standpoint. But part of the Indian rally is also because there has been extraordinary liquidity provided by the Reserve Bank and pressures from kind of fiscal stimulus from the government as well, either farm loan waivers or even arm twisting the Reserve Bank to put in more liquidity. Is all this just a short-term positive, or do you think, this is good to, trigger up the Indian economy?
I think it is obviously helpful at the margin for the Indian economy. I think we must remember as we step back that India, although obviously, as we know very well, there's been problems with corporate earnings growth in India for the last 2 or 3 years. Nonetheless, the Indian economy continues to be the best performer in the emerging markets overall, and likely these short-term measures will, I think, bolster that growth. And there's no doubt they've supported the economy. But frankly, as you know very well, I think you have to assume that some of the fiscal stimulus we're getting here at the margin and some of the liquidity provision has got a lot to do with the election, which is upcoming. So I don't think we can really rely on those stimulus to those policy stimuli to last for a sustained period of time. As you know, obviously, in India very well, what I think will make a big difference to the Indian market is how the RBI policy develops now that we've had, another change at the helm of the RBI. So I think monetary policy is uncertain, and there's a risk, of course, that if it's too loose, that does put the rupee under pressure and pull the market back. But I think you must expect to see reasonably accommodating policy between now and the election, not least because the room is there. I mean, you've got the room there because inflation is lower, or potentially can go lower because of the oil price. So I don't see this as being a set of factors which are just going to go away as far as India is concerned. Although, clearly, as you imply, the outperformance by India over the last last couple of months has been stunning. But then, as I say, it's been a relatively good period for emerging markets. If the U.S. economy is okay from it, the U.S. markets are okay from it, which I think is probably the case, I think emerging markets push on in 2019.
Okay, that's good to hear. And I completely agree with you. If there is fiscal stimuli and, monetary liquidity from the Reserve Bank, clearly there's space for it. Inflation is low and the rupee is in a fine spot because of lower crude prices. So we shouldn't expect any negative or any ultra-negative reactions. Thank you very much, Jeff Dennis, for staying up for us and giving us your reactions.